Another great indicator that you can use to really identify overbought and oversold positions is the stochastic oscillator, which just has kind of a fun name too, doesn't it? And since it's an oscillator, we know that the numbers are going to be positive numbers from 0 to 100%. Again, not going to show the price, it's going to show a percentage from 0 to 100% that you can use to evaluate. And we're going to show you that in a moment here. Oh, by the way, too, it's actually kind of poorly named. Stochastic actually means randomness. And what we're trying to do is find out order and patterns, right? And then it does help us with that. So I don't know why they chose that name, but it's not the perfect name for it. But it's a good momentum indicator. So let's take a look at the stochastic oscillator. So what it does is it looks not only at the closing price, but also how near is that close to the high or low of the day. You saw on some of our other types of momentum indicators, we're really looking at closing prices in a look-back period. And whether that's a certain day or an average, where this is going to get a little bit more mathematical and also look more how does it reflect both the high and the low of the day as opposed to just closing. So for example, if you have a close, the closing price is near the high, and each high is higher than the day before. Not only do you have an uptrend, but you have an uptrend that is accelerating. It's getting faster, it's getting stronger. So in a rally, prices will keep going up like that. Prices will keep going up, and you expect the price to close near the high of the day. In a sell-off, the opposite, prices are going down. You expect the price to close near the new low of the day. So in the example and in this little description, you can kind of see we're trying to measure, how strong are these trends? Are they accelerating? And stochastic oscillator, using that mathematical equations behind it, does that for us. In fact, if you're curious about the math behind it, here you go. Again, the trading platform will automatically do this for you and automatically, put the lines on the chart there for you, so you don't have to worry about doing the calculation. But it is an interesting calculation. There's some parts you need to kind of know about on there. One is you're going to see, because you're going to have some inputs later here, and we're going to talk about that, or some choices here in the next slide. First off, when you see something that says percentage K, that is the stochastic oscillator. So that if you're looking at percentage K, that's the indicator. And then it's going to be compared to a 3-day simple moving average, how the formula was developed there back in the 50s. And that's going to be identified as percentage D. Don't worry, there's nothing else in technical analysis that has a percentage K and percentage D or it gets weird like this. But on your chart, you're going to have these two lines, and they're going to be labeled percentage K and percentage D. Again, the percentage K is the stochastic indicator, and percentage D is a comparison to the 3-day simple moving average, and you're going to look at these two lines in tandem. Now, let's get to the worst slide of the course. Well, maybe not the worst slide, but they make it a little bit more complicated for you, or if you want it to be. So there's 3 common types of stochastic oscillators you can choose from. And usually these are all on your trading platform, and they're labeled a little bit weird, so I want to make sure I covered that for you. So you're going to see them labeled as fast, slow, and full. I wish they had better names, but that's what they call them: fast, slow, and full. So the fast stochastic oscillator, that's the original one. That's the original one we just looked at as far as the mathematical calculation. That's the basis. That's the basis for everything. So that's the base. Then you can choose something like a slow stochastic oscillator, which will help make your percentage K look a little less choppy. It smooths out even more. And you can see how the formula changed a little bit more. They added smoothed it out with a 3-day period SMA built right into the percentage K, and then comparing that to the 3-period SMA of the slow K, or slow, it's this 3-day SMA basically is what it is the slow percentage D. So what you're really getting with the slow one is a little bit less choppy of lines. You've seen them a little bit more choppy. You want to smooth them out, a little bit more. Then you could use a slow stochastic oscillator. And then there's the full stochastic oscillator, and all that really does is allows you to customize the number of periods. As remember, the number of periods is a kind of a default there. And that default is 14 days. If we were to look at the formula back in the previous slide, it's a 14-day default. So, but if you wanted to change that from 14 days, you can put in whatever number of periods that you want. And that's really what the full stochastic oscillator does. This gives you more flexibility in days. Again, a lot of research on things around stochastic oscillators. 14 days chosen for a reason. So it matches up with RSI, similar type thing. So you might want to stick with that. I would certainly recommend it. But you can also, it's perfectly fine if you become more comfortable with your trading. If you want to have more customization, you can certainly do that. I will tell you that most people use the original formula in the original format, or so they're choosing in effect, the fast stochastic oscillator if they have a choice on their trading platform. If you don't see choices, usually they give you one, but if you don't, then just if it says stochastic oscillator, understand that is the original formula and that is the fast one. Again, wish better names. So if we look at it graphically here, you're going to have your percentage K, the stochastic oscillator, and then your percentage D, which is that 3-day simple moving average of that percentage K. So it's a relationship between the two. And what it's going to do is it's going to generate two lines on your chart. You're going to see, you can kind of see here where it says STO, stochastic oscillator. The percentage K is 14 days. That's the default. The percentage D is 3, because that's the 3-day simple moving average, so that's the default too. Generates two lines on that, and you can see the two lines here right on the chart. And you can see that they kind of move a little bit in tandem, and you can see how the 3-day one, the pink one, is a little bit more smoother versus being less up and down. So that's because it's a shorter look back period. If you were to customize these and put, let's say, an 8-day for your percentage K, if you did customize it, it would then smooth out that percentage K a little bit more. But we like to use the default here, so that's what it kind of looks like as far as the default. All right, so that's great. Now, how do we use it? Well, here's how you use it, because you're trying to, again, recognize these overbought and oversold conditions. Overbought, traders think the current price rise is an extreme. It's too high. We're ready for a turnaround, and so we want to take our profits now. We're reaching the peak. So an overbought is indicated when the stochastic oscillator crosses above the 80% line. So in this case, you're looking for the 80% line, and you're looking for it when it's overbought, and you want to look for that. You're looking for it to be above the 80% line, and you're going to actually make the sell decision that it's overbought when the percentage K crosses below the percentage D. Okay, so you got two things going on here. We're looking for that overbought condition, and then we're looking for a sell signal, and that's going to tell us when we think we're getting really close to the peak, and that's that percentage K is going to cross below the percentage D. The overall or an oversold condition is when traders think the current price fall is an extreme. It's gone way down in price. There's few sellers, and the price is relatively cheap, and it's ready for a turnaround. That we're thinking buyers are going to start coming back in. And how we see this with a stochastic oscillator indicator is an oversold is going to be indicated when the stochastic oscillator, the percentage K, is below the 20% line. So there's no below zero. Remember, it's an oscillator, so it's between 0 and 100%. And there's no prices. It's a percentage, so it's going to go below the 20% line. And we're looking for the percentage K to cross above the percentage D to give us the indication that's the time to buy, right? So it's kind of like these two kind of sets of conditions that you need to meet for it to be kind of implemented. So if we looked at this again graphically on here, you're selling when the percentage K is above the 80% line, showing an overbought condition, and it's crossing below the percentage D. Now let's look at that visually on the chart there. And the same thing, you're going to buy at the low part when it's below the 20% line and crosses above the percentage D. So you can see where we have highlighted real strongly the blue lines there for the 80 and the 20% on the right-hand side. And you can see in this example with Tesla, there's conditions where it does that, where it's above or below, and it crosses over each other to kind of confirm the pattern within itself. And there's times when it's in between, and then you're taking no action at all. It's just neither overbought nor oversold. It's just kind of waiting for something to happen. Well, either a sell signal or a buy signal for that to happen within there. And in this view, you have the price chart on the left, and on the bottom of the left, and on the top is the stochastic oscillator. And you can see where the lines are crossing the 80 and 20% line, and also when they're crossing each other. And you can kind of see where that's happening, where it's looking at the chart itself on the right-hand side there, when that starts to kind of match up. And again, you want to have those two conditions be met, and that's the whole idea. Is you're trying to anticipate these buying and selling conditions. So if we look at the chart on the right, you can see where once we cross, actually when the crossing happens, that's when we see we're on this uptrend firstly, and we see the cross, it's above the 8% line, it crosses below, and that's where we're going to sell. And then as indicated, the indicator worked, and it showed a downtrend from there, then it flattened out, and then we saw we're kind of bottomed out. And as we saw it start to rise above that 20% line, we saw a buying condition, at least for a short period of time, where it might have been in a buying area. So that's another way that you can kind of look at these two as far as with the price charts. But a great way is to start just with your stochastic oscillator, be watching that, and then confirm it with other types of price indicators. By the way, we talked about fast, slow, and full stochastic oscillating charts. Fast is the original, with a 14-day. The slow is one that uses the original and kind of smooths out that 14-day price. And a full one is the one where you can input your own numbers. So if you look at the first two ones here, it's the exact same chart for Tesla and the exact same time period. And you can see that the one below, the fast STO or stochastic oscillator, a lot more jerky up and down, a lot more up and down there, not as smoothed out as far as the black line. If we make that into the slow one, you can see how it now adds an extra smoothing factor with a factor built into the equation, the SMA built into the equation, the simple moving average, in addition to the percentage D. And so that makes it a little bit easier to read and see as far as when these lines might be crossing. So sometimes you might see something using your traditional one, your original one, and then it's just a simple click of a button or two to overlay it with a slow one or replace it with a slow one to kind of see it a little bit better visually. Again, the full one on the bottom that's all customized between them. So whatever you put in is going to have a dramatic input on the chart. I used a 10-day for a shorter look back to see if it was more price sensitive, which would be more price sensitive by using it in a full STO. So if I like it, but I want to be more price sensitive and even more reactionary, then I might put in a shorter time period versus, let's say, a longer time period. So as you play around with this, you can kind of get an idea how they look. I would say most people, they're using the traditional, the original STO, or it would be termed as a fast, and then they might use the slow one to just kind of see it a little bit visually right before maybe they're decide they're going to do something, and they want to just make sure they're seeing what they're seeing a little bit clearer, and so they'll use the slow one in that aspect.